Welcome to the Deep Dive. Today we're tackling something really ambitious. Tony Robbins' Money Master the Game. This wasn't, a quick read. It was a 4-year deep dive by Tony himself, interviewing 50 of the absolute titans of finance.
Yeah, 50. That's intense.
His goal, to equip you with the knowledge to achieve real financial security, independence, and ultimately freedom, regardless of your current financial picture.
And what immediately struck me was Tony's intense personal drive behind this. He really felt that the financial world often doesn't prioritize the individual investor. Not really.
Right.
The fact that he insisted on recording the first and last chapters, even when, his health wasn't great, that really speaks volumes about his commitment. He wanted to get this crucial information into your hands, guiding you toward a better financial future starting right now.
Absolutely. And let's face it, talking about money can be, complicated. It's often avoided, loaded with emotional baggage, maybe even feelings of inadequacy or shame.
Totally. It's charged.
But the way Robbins reframes it is so powerful. He presents money as a tool, a resource that, when understood and managed effectively, can truly empower a richer and more fulfilling life.
That shift in perspective is absolutely key. And for anyone feeling maybe a bit wary of the term financial guru, it's vital to understand Robbins' methodology here. This isn't about fleeting trends or speculative bets.
No hype.
No, he's laser focused on proven, evidence-based strategies, learning directly from those who have achieved remarkable, sustainable financial success. His philosophy is simple. Success leaves clues.
Exactly. He's not interested in the financial entertainment that's so prevalent, the constant noise about the next hot stock. He's about cutting through all that hype and understanding the fundamental principles that actually work. And the book's structure is really designed to take you on that journey step by step through 7 key areas to build that financial foundation.
Now, while we won't dissect every single page today, we're going to plunge into some of the most crucial insights and actionable takeaways. Okay, let's unpack the very first step then, taking control. Robbins really hits home the fact that you, the listener, have far more power over your financial destiny than you might realize.
Yeah, that's empowering.
What really jumped out at me was the statistic he shares. A whopping 77% of Americans worry about their finances, yet only 40% have a concrete spending or investment plan.
Wow, 77% worry, but only 40% plan. That's a huge gap.
It's a significant gap between concern and, proactive action.
It's a real wake-up call. And he emphasizes that even those with high incomes aren't immune to financial ruin if they lack that foundational understanding. He cites some surprising examples: Francis Ford Coppola, Mike Tyson, Kim Basinger.
Big names.
Yeah, individuals who earned fortunes but ultimately lost them due to a lack of financial mastery. It just underscores that earning a lot isn't the same as managing it well.
Not at all. And what's particularly insightful here is Robbins' core principle for increasing your income. It's not just about chasing a bigger paycheck. It's about fundamentally increasing the value you provide to the world.
Value creation.
Exactly. He argues that by finding ways to do more for others than anyone else does, by becoming more valuable and serving more people, you naturally increase your earning potential. Think of that incredibly popular food truck in your city, or a top-performing salesperson, or even the founder of Instagram. They all excelled by offering exceptional value.
That makes perfect sense. Now, let's move on to a concept that's the bedrock of long-term wealth building, the power of compounding. Warren Buffett famously said his wealth came down to living in America, some lucky genes, and compound interest.
Compound interest. It sounds almost too simple, maybe, but the long-term effects are truly staggering.
They really are.
Robbins illustrates this beautifully. Imagine a single dollar that doubles in value every single year for 20 years.
Yeah.
That single dollar would grow to over $1 million. Just $1.
$1 million from $1.
That's the sheer force of exponential growth. But then, and this is crucial, he immediately throws in a reality check.
Taxes.
Taxes.
Yeah.
Always taxes. Right. If you were to pay, say, a 30% tax on those annual gains, that same dollar after 20 years would be worth just over $28,000.
Wait, from over $1 million down to $28,000. Wow, that's a stark difference.
Huge difference.
It really highlights that while compounding is powerful, understanding and minimizing the impact of taxes is just as vital. We'll definitely need to revisit that.
Absolutely.
And it underscores a critical insight. You can work hard and earn a good salary, But true financial freedom often requires making your money work for you through the magic of compounding.
Exactly. And that leads directly to the principle of paying yourself first and automating your savings. This isn't some newfangled idea, it's a timeless principle. Robbins quotes the richest man in Babylon. A part of all I earn is mine to keep.
Mine to keep. I like that. It's about saving a non-negotiable part of your financial routine.
Which, let's be honest, can feel like a huge challenge when you're just trying to cover current expenses, right? You might think, how can I possibly save more?
And where's the money going to come from?
But Robbins reframes it. Think of saving as paying your future self. You wouldn't skip paying your rent or your taxes, hopefully.
Hopefully not.
So why skip paying your own future financial well-being?
That's a great point. And the key to making this consistent, even when, willpower falters, is automation. As Burton Malkiel, the author of A Random Walk Down Wall Street, wisely put it, the best way to save is when you don't see the money in the first place.
Out of sight, out of mind.
Exactly. Setting up automatic transfers from your paycheck to a dedicated savings or investment account just takes the emotional decision-making out of the equation.
It truly does. And to demonstrate that this isn't just a strategy for high earners, Robbins shares some incredibly inspiring stories of everyday individuals who built substantial wealth through consistent saving over time. He talks about Theodore Johnson, a UPS worker, Osceola McCarty, a washerwoman.
A washerwoman, really?
Yeah, even Sir John Templeton. None of them were financial wizards, just disciplined, consistent savers. It's a powerful reminder that you don't need to be a genius to build wealth.
Consistency over genius.
Precisely. Which brings us to a really critical part of the book, becoming the insider and the crucial task of shattering common financial myths.
The myths.
Robbins argues that the financial landscape is full of potential pitfalls, or as he calls them, landmines, and understanding the real rules of the game is absolutely essential to navigate it successfully. As the saying goes, he who has the gold makes the rules.
Right, and the potential cost of not understanding these hidden rules. Robbins suggests that for the average person, it could translate to hundreds of thousands of dollars lost over their lifetime.
Hundreds of thousands. That's a huge incentive to really pay attention to these so-called myths.
Definitely.
Absolutely. The first myth, my advisor has my best interest at heart, actually tees us up nicely for a discussion about fiduciary duty, which is so important. But let's tackle the second myth first. Our fees are a small price to pay.
Oh yeah, the small fees.
This is where a lot of people get tripped up, and the long-term consequences can be really significant.
It really can. Robbins shines a bright light on the often hidden nature and the surprisingly large impact of mutual fund fees. He even quotes Senator Peter Fitzgerald, who likened the mutual fund industry to the world's largest skimming operation.
Skimming operation? That paints a pretty clear picture, doesn't it?
It does.
What's truly eye-opening is the cumulative effect of even seemingly small annual fees over decades. Robbins uses a powerful example. Imagine $10,000 invested with a 7% annual growth rate over 60 years.
Okay, 60 years.
You're paying 2.5% in total management fees each year, which doesn't sound like that much, maybe?
No, 2.5% sounds manageable.
Right. But the difference in your ending balance compared to paying minimal fees is staggering. You could be giving up a huge portion, like the majority of your potential returns. Jack Bogle, the founder of Vanguard, famously pointed out that fees can eat up anywhere from 50% to 70% of your potential nest egg over the long term.
50 to 70%.
Yeah.
Just gone to fees.
Gone. That's a massive takeaway right there. When you're looking at your own investments, the key insight isn't just the stated return, but what percentage is being eaten away by fees. A difference of even 1% can mean hundreds of thousands of dollars over decades. That's the real impact.
It really hits home that you might be unknowingly funding someone else's comfortable retirement more than your own. And he also touches on the often confusing concepts of dollar-weighted returns and time-weighted returns. Can you break down why that distinction matters to the average listener?
Absolutely. Think of it this way. A time-weighted return looks at how well the investment fund itself performed, regardless of when investors put their money in or took it out, like the fund's pure performance.
Right.
A dollar-weighted return, on the other hand, reflects your actual return based on the specific times and amounts you invested, so when you bought in, when you sold, or added more.
Oh, so my personal timing matters.
Exactly. The key insight is that those advertised average returns you see for a fund might not actually reflect the return you personally experienced, especially if you added or withdrew money at different times, maybe panicked and sold low. or bought high.
That's a really helpful way to understand it. So the advertised number isn't necessarily my number.
Not always, no.
Okay. Now, the third myth is you need to beat the market to succeed.
Yeah.
This seems, I don't know, counterintuitive to a lot of people who are constantly looking for the next hot stock tip, right?
Exactly. This is where Robbins champions the power of low-cost index funds, a strategy heavily advocated by financial legends like Burton Malkiel and, again, Jack Bogle.
Okay, so for those who might be new to this, an index fund is basically a type of mutual fund or ETF that just tracks a specific market index, like the S&P 500.
Right.
So instead of trying to pick individual winning stocks, you're essentially investing in a broad basket of companies that make up that index. The goal isn't to outperform the market, but just to match its overall performance, minus tiny fees.
And the evidence supporting this approach is pretty compelling. Robbins highlights that the vast majority of actively managed funds, we're talking around 96%, actually underperform their benchmark market index over the long term.
96% underperform.
Over the long haul, yeah, especially when you factor in their higher fees. So by becoming the market through low-cost indexing, you're not only likely to achieve better returns after fees, but you're also saving yourself a significant amount of time and, frankly, the emotional roller coaster of trying to time the market.
It's a powerful shift in mindset.
Mm-hmm.
Instead of searching for that elusive needle in the haystack, you just own the whole haystack.
Pretty much, yeah.
Now, the fourth myth is a big one, and it has to do with who you're trusting for financial advice. I'm your broker, and I'm here to help. That sounds reassuring on the surface, but there's a critical legal and ethical difference to understand.
Absolutely critical. Robbins clearly lays out the fundamental distinction between a broker and a fiduciary. A broker, legally speaking, is not necessarily required to act in your best financial interest. Their primary allegiance is often to their firm, to sell the firm's products.
Allegiance to the firm.
A fiduciary, on the other hand, has a legal and ethical obligation to put your interests first, above their own, above their firms. He uses a fantastic analogy here.
Yeah.
Thinking of brokers as being like butchers trying to sell their meat, whatever cuts they have. Whereas fiduciaries are more like dietitians advising on what's truly best for your long-term health.
Butcher versus dietitian, I like that.
So a fiduciary is legally obligated to recommend what's best for you, even if it means a lower commission for them. A non-fiduciary, a broker, might be incentivized to sell you a product that benefits their firm more, even if it's not the ideal choice for your situation. That's the critical difference.
That analogy really clarifies it. And Robbins points out that more and more people are recognizing the importance of this distinction and actively seeking out fiduciary advisors. He mentions Elliott Weiss Bluth and his firm Hightower as examples of companies built on this conflict-free advice model.
Yeah, the demand is growing. Then we come to myth number 6. Target date funds just set it and forget it. These are incredibly popular, especially within 401ks and retirement accounts, as a seemingly simple, hands-off investment solution.
Yeah, they seem easy. Pick your retirement year. Done.
Right. But Robbins urges us to take a closer look. He points out that while target date funds offer convenience, they can still have hidden fees baked in. More importantly, the underlying asset allocation within these funds, how your money is divided between stocks, bonds, etc., might not be the most appropriate for everyone's individual circumstances, risk tolerance, and time horizon. It's a bit generic.
So one size might not fit all, even if it's based on age.
Exactly. He even mentions the availability of services like Stronghold Financial that offer complimentary analysis of your 401k asset allocation, highlighting that there are resources available to help you make more informed decisions. And he points to historical examples, like the market downturn in 2008.
Oh, yeah, 2008.
Where even supposedly conservative target date funds, the ones for people closer to retirement, experienced significant losses, like 17%. The riskier ones lost almost 40%. It shows that set it and forget it doesn't always equate to optimal performance or, crucially, downside protection.
Which naturally leads us to a core principle of successful investing, asset allocation itself. Robbins dedicates a significant portion of the book to this, emphasizing that Nobel laureates and top institutional investors overwhelmingly agree that it's the primary driver of long-term investment returns, like over 90% of your return variability.
It's huge. In simple terms, asset allocation is how you strategically divide your investment portfolio across different asset classes. Things like stocks, bonds, real estate, maybe commodities, other alternatives based on your individual financial goals, your tolerance for risk, and the time frame you have for your investments to grow.
So it's about the mix.
It's all about the mix. The right mix isn't one size fits all. And as Robbins points out, there are readily available online tools and resources that can help you determine an appropriate asset allocation strategy for your specific situation. Before even looking at specific investments, understanding your desired asset allocation is the crucial first step.
Get the buckets right first.
Get the buckets right.
Now, in a section titled Upside Without the Downside, Robbins touches on a concept that I think is incredibly appealing to many people. The idea of capturing potential market gains while also having a built-in safety net to protect against significant losses. Sounds like the Holy Grail.
It does sound appealing, doesn't it? What's fascinating here is he hints at sophisticated investment strategies and certain types of financial instruments, often utilized by wealthier investors that aim to provide exactly that participation in market upside while limiting the potential for significant downside risk.
Like structured notes or certain annuities, maybe?
Things like that, potentially. Well, he doesn't go into extreme detail in this section for the average reader. It introduces the intriguing possibility of structuring your investments in a way that addresses the very real fear many people have of market crashes just derailing their financial progress entirely.
Yeah, protecting the downside is huge for peace of mind. And that naturally segues into invest like the 0.001% the billionaires playbook. It's about learning from the absolute masters of the financial world, names like John C. Bogle, Ray Dalio, David Swenson, individuals with decades of just unparalleled success.
Right. He briefly touches upon Ray Dalio's renowned all-weather portfolio as an example of an asset allocation strategy. Dalio designed it to perform reasonably well across various economic conditions: growth, recession, inflation, deflation.
The all-weather name makes sense then.
Exactly. Historically, it has delivered pretty strong returns across these different environments, with relatively limited downside volatility compared to, say, just owning stocks. It's a glimpse into the principles and approaches that some of the most sophisticated investors in the world employ to manage and grow their wealth consistently.
Then, in a section called Just Do It, Enjoy It, and Share It, Robbins shifts the focus back to the individual. He emphasizes the critical importance of taking concrete action on the knowledge you've gained. It's not enough to just read the book or listen to this deep dive.
Right, knowledge isn't power unless it's acted upon.
Exactly. You actually have to implement these strategies in your own financial life.
And he also touches upon the profound impact and, frankly, the fulfillment that can come from giving back and sharing your wealth once you've achieved a level of financial security. It's about creating a life of abundance that extends beyond just your own financial well-being, the share it part.
That's a great point. Now, there's a whole section dedicated to speeding up financial freedom. He outlines 5 key levers you can pull to accelerate your journey towards financial independence. The first, perhaps obviously, is to simply save more of your income and consistently invest that difference.
Makes sense. More fuel for the fire.
Right. Even small increases in your savings rate can have a surprisingly significant impact over the long run, thanks to that power of compounding we discussed earlier.
Absolutely. The second way is to actively seek opportunities to earn more, to increase the value you bring to the marketplace, and then, crucially, to invest that additional income. Don't just spend it because you earned more.
Invest the difference.
Invest the difference. He highlights inspiring examples of entrepreneurs like Nick Woodman of GoPro and Sarah Blakely of Spanx, who identified needs, created immense value, and were handsomely rewarded financially.
The third lever, and one we've already touched on quite a bit, is to relentlessly reduce the fees and taxes associated with your investments and then invest those savings.
Plug the leaks in the bucket.
Exactly. As we saw with the compounding examples, minimizing these drags on your returns can have a dramatic effect on your long-term wealth accumulation. It's not just about what you make, it's about what you keep.
So true. The fourth way to potentially speed up your progress is to aim for better investment returns. Now, this needs care.
Right. Higher return usually means higher risk.
Usually. Robbins briefly mentions real estate, specifically senior housing REITs, as a potential area to explore for potentially higher returns, driven by demographic trends. It's important to note that this also comes with its own set of risks and requires careful research, but it illustrates the concept of actively seeking out potentially higher growth opportunities within your overall asset allocation, not betting the farm.
Within the plan, yeah. And the fifth way might surprise some people. It's about making conscious choices to change your life and lifestyle for the better in ways that can positively impact your finances.
How so?
This could involve anything from relocating to a more affordable area or maybe a state with lower taxes to making deliberate choices to reduce unnecessary spending and live more efficiently. cut the waste.
So lifestyle design influencing finances.
Exactly. He even shares his own experience of moving from California to Florida and the significant tax benefits they realized. It's a big move, but it illustrates the point.
It does. Finally, Robbins delves into the internal barriers that often hold us back from achieving our financial goals in a section called The Lies We Tell Ourselves.
Ah, the internal game.
Right. These are the deep-seated limiting beliefs and negative narratives we create about money that can sabotage our efforts before we even begin. The stories we tell ourselves.
He shares a particularly powerful story about Julie, a screenwriter who harbored significant negative beliefs about money stemming from her parents' experiences during the Great Depression. Very common generational stuff.
Very. It wasn't until she consciously confronted and actively changed her internal story around money that she was finally able to make real and lasting financial progress. She had to rewrite her own script, so to speak.
Rewrite the script. Nice one.
What's truly insightful here is the strong connection Robbins draws between our mental and emotional state, our psychology, and our ability to take effective financial action. He even references Amy Cuddy's research on power posing, illustrating how even subtle changes in our physical posture can influence our confidence and willingness to take calculated risks.
Stand tall, feel powerful, act bolder.
Something like that. Ultimately, overcoming those internal psychological hurdles is just as crucial as understanding the external financial strategies. You need both.
So as we bring this deep dive into Tony Robbins' Money Master the Game to a close, the overarching message is incredibly empowering, isn't it? True financial freedom isn't some unattainable dream reserved for a select few.
No, definitely not.
It's a very real possibility for you, our listener.
Exactly. The game of money can be mastered. It requires a willingness to learn the fundamental rules, which Robbins lays out with such clarity and, let's face it, passion.
Oh yeah, the passion is undeniable.
And then crucially, taking consistent action, even if it starts with small, manageable steps. Don't get overwhelmed, just start.
We really encourage you to explore these concepts further and to reflect on how these insights might apply to your own financial journey. What resonated with you most from our discussion today? What's maybe one thing you might start thinking about differently when it comes to your money?
Yeah, mull that over. And here's maybe a final thought to really chew on. What specific limiting belief about money might be holding you back right now from taking that first or maybe the next important step towards your financial goals? What's the story you tell yourself?
Good question.
And following on from that, what is one small concrete action you can commit to taking today, like right now, to begin challenging that belief? Just one small step.